Happy morning to all. So we are doing MAT for Ind AS company. Actually 5 topics to be discussed in the MAT. Number 1, introduction to MAT, MAT for Ind AS company, MAT in special cases, MAT credit under 115 JAA and computation of total income under MAT and normal route. In that we have completed the introduction to MAT and we have completed the MAT structure. We are talking about MAT for Ind AS company. In addition to 115 JB subsection 2, we are supposed to do 2 more adjustment. One is 115 JB subsection 2A and 115 JB subsection 2B and 115 JB subsection 2C. Number 1, annual adjustment, every year adjustment 115 JB subsection 2A and 115 JB subsection 2B. Transitional adjustment, that will not there for every year, only for 5 years. So 1/5 of transition amount we should adjust as per 115 JB subsection 2C. The summary of last class discussion is, you have to see the P&L account. In that P&L account 2 items will be there. Items reclassified to P&L, items not reclassified to P&L. If any item is item reclassified to P&L, ignore it. No MAT adjustment is required, because automatically it will be reclassified to P&L in the future year. Whereas item not reclassified to P&L, MAT adjustment is required, because if we miss now, we will not have a chance to tax it. 115 JB subsection 2A annual adjustment. What 115 JB subsection 2A annual adjustment is saying that we are having 2 type of adjustment, OCI adjustment, demerger adjustment. OCI adjustment, you have to classify into 2 category, item that will be reclassified to P&L and item not reclassified to P&L. Item that will be reclassified to P&L, ignore it. Item not to be reclassified to P&L, tax it. In that 2 possibilities are there. You have debited the P&L account, credited the OCI account. Then, my dear lovable students, since you have debited the P&L account, sir, you should add back. Whereas you would have credited the P&L account by debiting the OCI account. Because of crediting the P&L account, profit would have been increased, so you have to reduce it. With regard to demerger adjustment, as per the respective Ind AS, if you distribute non-cash asset to the shareholders of the resulting company during demerger, and if that amount may be gain or loss, if it is loss, you will debit to P&L account, should be added back. And if it is profit, you will credit to the P&L account, you have to reduce it. These are otherwise called as annual adjustment 115 JB subsection 2A. But we are having exception to the item not reclassified to P&L, even though it is falling under the group of it is not reclassified to P&L. So we are having 2 exceptions. Number 1, revaluation surplus and gain or loss from investment in equity instrument designated at fair value. Revaluation surplus and gain or loss from investment in equity designated at fair value, we will be taxing only at the time of sale or disposal or transfer. We will not tax it at the time of creation. Right, sir, fantastic, sir. So retirement, disposal, realization or otherwise transferred. This is what 115 JB subsection 2A. The most important point in this chapter is time of taxation. You should know these 4 things when it will be taxable. It is like the time of supply in our IDT. Number 1, changes in revaluation surplus of PPE and intangible asset. That is Ind AS 16 and Ind AS 38, my dear lovable students. To be included in the book profit at the time of realization, disposal, retirement or otherwise transfer. That means notional gain or notional loss should not be adjusted in the MAT. When it is really realizing, at the time you are supposed to pay the MAT. So at that time alone you included in the book profit. Gain or loss from investment in equity instrument designated at fair value through other comprehensive income. This is NSR. You have invested in some equity shares, you are making it to market losses. So you are either debiting the P&L account or crediting the P&L account. Again, this has to be included in the book profit at the time of realization or disposal or retirement or otherwise transferred. That means both these items will not be included in the book profit at the time of creation, at the time of disposal or transfer or realization. These things will be taxed. Remeasurement of defined benefit plans, Ind AS 19. That means I would have actually till now followed the Indian accounting standards. Now I am converging with the IFRS, that is Ind AS, my dear lovable students. Because of that, I would have revalued the assets and liabilities. Sometimes I would have remeasured the liability. I would have understood that this much liability is not required. So every year it may undergo a change. So to be included in the book profit every year as the remeasurement gain and losses arises, not at the time of sale. What you are supposed to be sell, this defined employee plans and all, we can't sell. Sir, PPE and intangible we will sell, and equity instrument, equity investment we will sell, but this employee benefits and all we cannot sell. So don't wait till the last year, tax it year by year. Any other item which are not covered under this three category to be included in the book profit of every year. This is what 115 JB subsection 2A talking about, when it has to be taxed and what are the items to be taxed. With regard to 115 JB subsection 2B, in case of a demerger, my dear lovable students, there will be two companies are there. Number one, demerged company and the resulting company. If the resulting company is not recording the assets which has been distributed by the demerged company at the book value of the demerged company, then that surplus or loss should be ignored for the purpose of computation of MAT. That means in a demerger, in case of a resulting company where the property and the liability of undertaking received by it are recorded at a value different from the value appearing in the books of accounts of the demerged company, immediately before the demerger, any change in such value shall be ignored for the purpose of computation of book profit of the resulting company. So when you are calculating the MAT of the resulting company, sometimes they would have got assets and liability from the demerged company. They will not record at the same book value. Automatically that item will be adjusted as either goodwill or capital reserve. So that profit or loss should not be taken into account for the purpose of computation of MAT. So this has to be excluded as per 115 JB subsection 2B. And 115 JB subsection 2C is talking about transition amount. On the year of convergence, there may be huge differences between the account balances as per the old scheme and also as per the new scheme. These balances we will deposit in a convergence account and transition account, and the transition amount can be write off over a period of 5 years. But what Ind AS, what book profit computation for that Ind AS company are saying that if that item has been debited to P&L account should be added back, and if that item has been credited to P&L account should be reduced. That means transition amount may be allowed as per the General Act, that is Ind AS, but not allowed as per the book profit. It should be added back or reduced. And when you are calculating that, these items should not be taken to consideration. OCI, which will be reclassified to P&L, will not go to the transition amount. Then revaluation surplus of any asset as per Ind AS 16 and Ind AS 18, gain or loss from the equity instrument as per Ind AS 109, PPE or intangible asset, sir, as per the deemed cost concept, or investment in the subsidiary, joint venture and associates deemed cost concept. And the last one, cumulative translation difference of foreign operation. Sir, these items will not go and park in the transition amount. We have read with the year of convergence. And we have done one question from the Ind AS MAT, which is a basic question. I will be straight away moving into the question number 2 and question number 3, my dear lovable students. And we will try to finish it off, sir, Ind AS MAT. Question number 2. This is a big question. Yes. Zenith Formulations Limited, an Indian company engaged in the pharmaceutical formulations in Tamil Nadu, started adoption of Ind AS compliance with effect from 1st April 2019. So they started Ind AS compliance. Following particulars are furnished for the year under 31st March 2024. Our year financial information has been given. The book profit after adjustment of all items specified in 115 JB subsection 2 amounted to rupees 52.26 lakhs. So they themselves made all the adjustments, normal adjustments, 115 JB subsection 2 adjustments, except the adjustment of brought forward loss for the year ending 31/3/2024. So they have not made the Brought forward business loss or unabsorbed depreciation as per books, as per books, as per books. Before that, they got a net profit of 52.26 lakhs. So we are supposed to do only 3 adjustments in order to find out the Ind AS math. You have to check, is there any 115 JB subsection 2A adjustments are there. If 2A annual adjustments and 2C transition adjustments are there, then that has to be adjusted to get the correct book profit, then pay tax. Okay, fine. Brought forward losses as per the books, as per books, as per books are as follows. Business loss, we know that 4.6 plus 4.6 plus 1.75 comes to 6.35 is the amount of business loss. Unabsorbed depreciation 4.9 plus 2.2 comes to 7.1 is the unabsorbed depreciation. So whichever is lower, if you take 6.35. So we are supposed to reduce 6.35 because they have made all the adjustment, but brought forward business loss or unabsorbed depreciation as per books has not been adjusted. So we have to adjust it. But what they are saying, the business loss of 4.6 lakh and 1.75 lakh have been deducted while computing the book profit under 115 JB for assessment year 22-23 and 23-24 respectively. So already you had set off this 6.35 lakhs in the earlier previous year when you were calculating the MAT. That means automatically this will become vanish, this will become zero. In the books of accounts, this loss won't be there because you have already set off the losses when you are calculating the book profit in the earlier year. So it will become 0 or 7.1 lakhs, whichever is lower, it will become 0. Then we can't adjust anything, my dear lovable students. The particulars of OCI, other comprehensive income for the year ended 31st March 2024. We are having 2 heading. Other comprehensive income that may be reclassified to P&L. If it is reclassified to P&L, as per our MAT adjustment, you have to just put a cross like this. Don't even read the question. Just they have given to confuse you. Don't adjust that part because it will automatically reclassify to P&L. Why are you worrying about it? But other comprehensive income that will not be reclassified to P&L. That will not be reclassified to P&L. We have to be very careful. In this 115 JB subsection 2A adjustments will be applicable except 2 items. So changes in fair value of equity instrument, don't do adjustment now because it has to be adjusted at the time of sale. Deferred gain on cash flow hedge. This deferred gain, you have to tax it. If you miss to tax it now, this gain, sir, it will be swaha for the government. So you have to tax that 7.25. Deferred cost of hedging, you can reduce it because it's a deferred cost. Cost means loss. So this has to be, sir, adjusted against the book profit now. Share of other comprehensive income of other associates. That means from the other associate company, they got a profit, that is share of other comprehensive income. This will not be reclassified to P&L. So it is income, we have to tax it. Sir, next one, remeasurement of post-employee benefit obligation. Remeasurement, because of remeasurement, credit came. Credit means income, so we have to tax it. That means the obligation has been reduced. That's why they have treated it as income. If we miss that, my dear lovable students, the government will lose the chance, so we have to tax it. Revaluation for surplus for asset, this is not the right time to tax it. Let it actually realize. Now you don't tax it that when you are booking the book profit. So this is the first one. The next one, transition amount as on convergence date, that is 1/4/2019, stood at 52.50 lakhs. So we have merged the old system with the new system. So we have parked all the differences to an account called as transition amount. What is the total transition amount? 52.50 lakhs. It is credit balance, they are saying. Fine. So transition amount is credit balance. Including capital reserve of 8 lakh and adjustment of 4.5 lakhs relating to translation difference in a foreign operation. We have already discussed that. 6 things will not come when you are taking the transition amount. Here I have written, just now I have revised for you, my dear lovable students. This is what they are talking about. This is what they are talking about. Sir, transition amount means the amount or aggregate of amount adjusted in the other equity excluding capital reserve. It should not be there, capital reserve and security premium reserve. And capital reserve and security premium reserve should not be form part of transition amount. Fine. and these 6 items should not be included in the transition amount. In that 6 item, my dear lovable students, we have talked about OCI reclassification adjustment and revaluation surplus of asset, gain or loss on equity instrument, or PPE or intangible asset, or subsidiary joint venture or associate adjustment, and the last one is cumulative translation difference of foreign operation. Adjustment relating to cumulative translation difference of foreign operation in accordance with para D13 and Ind AS 101 on the convergence date. So that will not form part of the transition amount, but what they have done, they have made that as form part of the transition amount. So my dear lovable students, the transition amount as on conversion date stood at 52.5 lakhs credit balance, including capital reserve of 8 lakhs. So this capital reserve, we have to remove it. And adjustment of 4.5 lakhs relating to translation difference in foreign operation, these two should not form part of the transition amount. So we have to purify the credit balance in the transition amount, then we have to make whatever adjustment. The National Company Law Tribunal, Chennai, benches admitted an application under section 7 of the Insolvency and Bankruptcy Code made by financial creditor against the company for initiation of corporate insolvency resolution, then brought forward business loss and unabsorbed depreciation. What we have said here is it becomes 0, so nothing can be reduced. Since they are applied for insolvency and sir, this plus this is allowed, so that 7.1 lakhs can be reduced. Compute the MAT liability for assessment year 24-25, applying the provision relating to Ind AS compliant company, super fantastic to the core. Then assuming that the income tax paid under the normal provisions of the Income Tax Act for assessment year 24-25 works out to 7.2 lakhs. Compute the tax credit, if any, to be carried forward by the company, including the period up to which it will be available to be carried forward, is a question. This is a 10-mark worth question for examination, Ind AS MAT question. So computation of book profit under 115JB, fine. Book profit after adjustments of item under 115JB subsection 2, these are normal adjustment. This is normal MAT. Whatever we know, they themselves have been adjusted. Then we have to specifically know the 3 adjustments. So 52,26,000, fine. Except brought forward business loss and unabsorbed depreciation. Okay. So we are starting adjustments as per explanation 1 to 115JB subsection 2A. 2 itself they missed one item. No. 2 itself they missed one item. Brought forward business loss, my dear lovable students. With regard to brought forward business loss, we are having 2 things are there. One is, sir, 4.6 lakhs plus 1,75,000 comes to 6,35,000 is the brought forward business loss. Sir, 6,35,000 is brought forward business loss, and you are having unabsorbed depreciation. What is that unabsorbed depreciation? 7,10,000 rupees. They have given both 7,10,000, 6,35,000 and 7,10,000. You read the notes. Sir, since Zenith Formulation Limited is a company against which an application for corporate insolvency resolution process have been admitted by NCLT, under section 7 of the Insolvency Bankruptcy Code, the aggregate amount of loss brought forward and unabsorbed depreciation is allowed to be reduced from the book profit for the purpose of levy of MAT. Under section 115JB, both are allowed, but however, the business loss of 6,35,000 which have been deducted while computing the book profit of assessment year 21-22 and 22-23 shall not be deducted again from the book profit, because already you have reduced in the earlier year. So from 52,26,000 you can reduce only unabsorbed depreciation of 7,10,000. So 52,26,000 minus 7,10,000 comes to, sir, 45,16,000. Sir, can I reduce 6,35,000, sir? I cannot reduce 6,35,000 because already it has been what? Reduced. So what is written here? Book profit after adjustments of item under 115JB subsection 2 is 52,26,000. That is a net profit given. If you see here 52,26,000, they said that except the adjustment of brought forward loss. Except the adjustment of brought forward loss means brought forward losses they have not adjusted. Actually we are having 2 losses, business loss and unabsorbed depreciation. Since the company has been, against the company corporate insolvency has been admitted, both are actually allowed, but already business loss has been reduced in the earlier year, Hence, we cannot reduce the business loss again. So, unabsorbed depreciation of 7.1 lakhs can alone be reduced. So, this is a printing mistake, man. 52 lakh 26,000 minus unabsorbed depreciation of 7 lakh 10,000 comes to, it should be 45 lakh 16,000 rupees is the book profit computed in accordance with explanation 1 to section 115 JB subsection 2. Now we reach the normal. Now I have to adjust the OCI adjustment. Items credited to OCI that will not be reclassified to P&L. Only that item, sir, I will be taken into account. Number 1, deferred gain. Deferred gain means I will add 7,25,000. I have to add. Share of OCI of other associates. Share of income means it is income. I should add. Remeasurement of post-employment benefit obligation. Because of remeasurement, we are having credit balance. So profit we should add. Revaluation surplus for asset. Now that is not the right time. So 7,25,000 plus 3,20,000 plus 4,45,000 comes to this amount I should add 14,90,000. So 45 lakh 16,000 plus 14,90,000 comes to, sir, it should be 60 lakh 6,000. Alright. Items credited to OCI that will not be reclassified to P&L. Items credited to OCI means it is debited to what account? P&L account, should be added back. Deferred cost of hedging 4,10,000. Yes, sir. Changes in fair value of equity instrument, put it on dustbin because this is not the right time of taxation. It man. So 4,10,000 has been credited to OCI. That means that has been debited to P&L account. So these items has to be reduced because items credited to OCI that will not be reclassified to P&L. Deferred cost of hedging. Here you look at it. Deferred cost of hedging, it has been debited. It is a debit balance. Debit balance means it's a loss. Correct? 4,10,000. So you can reduce now. So reduce the 4,10,000. You will be getting 55,96,000 as balance. Now 1/5 of the transition amount, they mentioned that it has credit balance. Transition amount is 52,50,000. We already studied that, sir, capital reserve, security premium should not come. Sir, so amount to be excluded from the above, capital reserve has to be reduced, and translation difference in foreign operation 4,50,000 should be reduced. So from 52,50,000, if you reduce 8 lakhs and 4,50,000, you will get 40 lakh. This 40 lakh, since the transition amount is, sir, showing credit balance, 1/5 of 40 lakhs, 8 lakhs, you have to add it to the net profit because that ledger is showing credit balance. So what journal entry you have to pass? Transition amount account debtor 8 lakh to P&L account 8 lakh. So you have to add it, that 8 lakhs man. So 55,96,000 plus 8 lakhs comes to 63,96,000 will be the amount. Then on this amount you have to calculate 15% MAT into 15%. From here onwards is very simple. From there onwards 4%, you will get the MAT liability. If you round off, MAT liability will be whatever mathematical figure you are getting will be that. Then MAT liability as per this question they have calculated is 8,98,720, whereas income tax computed as per the normal provision they themselves given in the question. So 7,20,000, which we know that whichever is higher, so MAT liability is higher. So the difference of the tax payable as per the MAT and tax payable as per the normal route can be carried forward for 15 assessment year. Can be carried forward for 15 assessment year. That's what this question is, a very easy question. Only in examination confusion, where the confusion should come is OCI that may be reclassified to P&L. Don't do any adjustment, don't touch it. This you cross it. Whereas OCI that will not be reclassified to P&L, you tax it now, otherwise what? You will lose the chance of taxation. But in that two exception is there. Fair value of equity instrument, don't tax it now, plus revaluation surplus for asset, don't tax it now. All the others, if it is income, add it to the book profit. If it is expense, reduce it from the book profit. Super. Then here with regard to this, you should know what and all form part of transition amount. Transition amount means an item which are adjusted in the other equity. In there, my dear lovable students, we will not include security premium and the One more item, capital reserve. Capital reserve and security premium will not form. And we are having 6 exclusion. In that, one of the exclusion is translation difference in a foreign operation. Then here you may have doubt, sir, the question has been given book profit after all adjustments except the, sir, brought forward losses. 2 brought forward losses has been given, business loss and depreciation has been given. In that, they said that the business loss of 4.6 lakh and 1.75 lakhs has been deducted while computing book profit under 115 JB. So already it has been deducted, so in books it would have become 0. Once you deducted, set off the loss, then it will become 0. So only unabsorbed depreciation will be there. That unabsorbed depreciation can be claimed because the company has been admitted for corporate insolvency. There are number mistakes are there. Conceptually we are done. I hope that you will be able to appreciate or understand. I am moving into the illustration number 3. Ansuk Chandra Flours Mills Limited, a domestic company engaged in manufacture of wheat flour, furnishes the following information pertaining to the year under 31/3/2024. Net profit as per statement of P&L 77 lakhs after considering the item 2 to 6 below. That means they have debited or credited this item, my dear lovable students. Company is a member of Vishnu Foods and Company, an AOP in which the member shares are determinate and their shares in P&L are clearly known. Entire income of AOP is from business activity. During the year, the company has derived share income of 9 lakhs from the AOP. Company has spent a sum of 90,000 towards earning such income. That means this 9 lakh has been credited to P&L account, should be removed, and 90,000 debited to P&L account should be added back. So 9 lakhs should be removed and 90,000 should be added back. Company has provided for income tax including interest of 234 BNC of rupees 62,000 for 3 lakhs and 5 lakhs towards share in loss of foreign subsidiary. So all the provision for income tax 3 lakhs should be added back, and provision for loss of subsidiary 5 lakhs should also be added back. Amount debited to the statement P&L account towards interest to a public financial institution of rupees 12 lakh. Out of this 4 lakh was paid. This is a 43B item, nothing to do with the matter. Company committed breach of building norms while extending the factory building. The city corporation initiated proceedings against the company, and company settled the issue by paying compounding fees of 1 lakh. Compounding fees is a penalty as per Millennia Developers Private Limited. We have done the case laws in the class. As per that case law, this should be added back as per normal route. This amount form part of general expense which has been debited to statement of P&L account. In MAT, nothing to do with the penalty amounts. In the administrative expenses, company has debited 70,000 towards fees for delayed filing of statement of TDS under 234E of the Income Tax Act. Nothing to do with the MAT provision. Other information, company has credited revaluation surplus of 10 lakh on fair valuation of asset under Ind AS 16 and Ind AS 38 to other equity. So, revaluation surplus of asset we will not adjust year by year, we will adjust at the time of final. Company has credited rupees 5 lakh to other comprehensive income on fair valuation of equity instrument in which company has investment. Both should be ignored, basically no adjustment from the MAT, Ind AS MAT. During the current year, depreciation charged as per the books of accounts of the company same as allowable under the Income Tax Act before considering the provisions of 32 subsection 2. Company proposed to adopt this practice consistently in future years. If the board of directors are okay for that, then the company can even follow the depreciation as per the Income Tax Act. You are required to compute income tax payable by the company for assessment year 24-25. Company is an Indian Accounting Standard compliant company, that means Ind AS company, and turnover of the company for previous year 2021 was 250 crores, which is less than 400 crores. So 25% will be applicable instead of 30%, my dear lovable students. So computation of book profit under 115 JB, net profit as per statement of P&L, already they have given 77 lakh. Add net profit to be increased by the following amount as per explanation 1 to section 115 JB. Expenses on earning the share of income of AOP, since share of income from AOP is exempt under section 86. So this amount has been debited to P&L account, should be added back. Income tax and interest under the Income Tax Act, 3 lakh should be added back because income tax paid or payable. Loss of foreign subsidiary should be added back. Straightforward, these all are normal MAT adjustment. Revaluation surplus on fair valuation of asset, you are not supposed to adjust now, it has to be adjusted at the year of actual sale. Gain or fair valuation of equity instrument, you are not supposed to adjust now, you are supposed to adjust in the year of actual sale. So 5 plus 3, 8 lakh plus 90,000, 8 lakh 90,000 should be added back to 77 lakh. So subtotal has become 85 lakh 90,000. Less net profit to be decreased by the following amount as per the explanation 12115 JB. Share of AOP, since it is exempt under section 86, this is 9 lakh, no need to pay tax. So book profit comes to 76 lakh 90,000. On that 76 lakh 90,000, pay MAT at the rate of 15%. So 76 lakh 90,000 into 15% comes to 11 lakh 53,500. On this, add health and education at 4%. So MAT payable will be 11 lakh 99,640, my dear lovable students. Now, these are the working note. No adjustment is required in computation of book profit under 115 JB for the following expense. Interest on financial institution, idukku MAT ku sambandhame kadayadu. Compounding fee for breach of building law and filing fees for late fee of TDS returns. As per Supreme Court in Malayalam Manorama Company Limited, company can follow rate of depreciation given in Income Tax Act while preparing the P&L as per Companies Act. We have worked out only as per the MAT. We have not worked out as per the normal route. That is coming, questions are coming. So this is the one line summary of the MAT, my dear lovable students. In this we have given the FAQs, which are nothing. One second. If you want, you can read this FAQs. Otherwise, straight away you can leave this. There is no compulsion that you should mandatorily read it. For example, I will read one question for you. Profit for the period may include mark-to-market gain or loss on account of fair value adjustment on account of various financial instruments recognized through profit or loss. A situation may arise where the loss on account of fair value adjustment could be added back in view of clause 1 of explanation 12115 JB subsection 2 of the Act. Whether the losses on such instrument require any adjustment for computing book profit for the purpose of MAT. Sir, if it is provision for diminution in the value of asset, we should add it back. Since the mark-to-market gain recognized through P&L on FVTPL classified financial instruments are included in book profit for MAT computation. It is clarified that MTM losses on such instrument recognized through P&L shall not require any adjustment as provided under clause 1 of explanation 12115 JB. However, in case of provision for diminution or impairment in value of asset other than FVTPL financial instrument, the existing adjustment of clause 1 of explanation 1 to section 115 JB subsection 2 of the Act shall apply. It is further clarified that for financial instruments where gain and loss are recognized through OCI, amended provisions of MAT shall continue to apply. So what is the question they are asking? The profit for the period may include, that means in your net profit, the net profit as per P&L, that is our starting point. It may include mark-to-market gain or loss on account of fair value adjustment of various financial instruments recognized through profit or loss. A situation may arise where the loss on account of fair value adjustment could be added back in view of clause 1 of explanation 1 to section 115 JB subsection 2 of the Act. Whether the losses on such instrument require any adjustment for computing book profit for the purpose of MAT. Yes, if you are creating any provision for diminution in the value of asset or impairment of the asset, if you are creating like that, then that losses should be added back. Otherwise, generally, sir, no need to add back any losses, my dear lovable students. Right. Sir, for the purpose of 115 JB of the Act, what shall be the starting point for computing book profit for Ind AS compliant companies is the question. For Ind AS compliance company also net profit as per P&L account is a starting point. But from that net profit we will adjust all the 115 JB subsection 2 normal adjustment and we will come to book profit as per section 115 JB subsection 2. From there we will be doing 3 adjustment, we will get the book profit for Ind AS company. Whether the profit before OCI other comprehensive income, that is item number 13 in part 2 statement of P&L of division 2 of schedule 3 to the Companies Act, or the total comprehensive income including OCI item number something in part number 2 of division 2 of schedule 3 to the Companies Act shall be starting point. The starting point will be above OCI. We have done one question which is question number 1. In that OCI was presented, we have taken the net profit as per P&L account. The year in FAQ have been modified considering that the transition to Ind AS is taking place in previous year 23-24. Starting point for computing book profit for Ind AS compliant companies shall be profit before OCI. Kandipa. Even we have done question number 1, the profit should be profit before OCI. Item number something in the part number 2 of the schedule of P&L of division 2 of the schedule 3 to the Companies Act. Fantastic, sir. As per explanation 1 to 115 JB subsection 2C of the Act, convergence date is defined as the first day of the first Indian accounting standard reporting period as defined in Ind AS 101. The memorandum explaining the provision of Finance Bill 2017 mentioned that adjustment as on the last day of the comparative period is to be considered. It may be clarified as to what would be the appropriate manner of computation of transition amount on convergence date, that is 1st April, at the start of the day or the end of the day. So they are talking about Ind AS is saying that convergence date is 1st of April, whereas our law, income tax law, is saying that end of April. What date you will take? One clarification they are asking. In the first year of adoption of Ind AS, the first year, company would prefer Ind AS financial statement for reporting year with a comparative financial statement for the immediately preceding year. So they have to make the last year also as per Ind AS and current year also as per Ind AS, then only they can compare. As per Ind AS 101, the company would make all the Ind AS adjustments on the opening date of the comparative financial year. The entity is also required to present an equity reconciliation between the previous Indian GAAP and Ind AS amount both on the opening date of the previous year as well as on the closing date of the preceding year. The amount as on start of the opening date of the first year of adoption should be considered for the purpose of computation of transition amount. For transition amount, first day should be considered. Fine. For example, company which adopted Ind AS with effect from 1st day of April 2023, number financial year, are required to prepare the financial statement for 23-24 as per the requirement of what is Ind AS. So current year they will prepare the financial statement as per Ind AS. Such companies are also required to prepare an opening balance sheet on 1st day of April 2022, that is last year, and restate the financial statement for the comparative period 22-23. So current year Ind AS, last year AS means we can't compare. The users of the financial statement cannot compare. In such a case, the first time adoption adjustment as on 31st day of the March 2023 should be considered. On 31st March 2023 should be considered. That is the start of the business on 1st day of April 2023 or equivalently close to the business on 31st day of the March 2023 for computation of MAT liability for the previous year 23-24 and thereafter. That means நம்ம financial year 23-24ல adopt பண்ணிருந்தாங்கன்னா நம்மளை பொறுத்த வரைக்கும் Ind AS வந்து 1st of April 2022ல இருந்து opening balance sheet நம்ம prepare பண்ணோம் இல்லையா, because comparative purpose காக current year ஓடையதும் last year ஓடையதும் compare பண்றாங்க. So such companies are also required to prepare a opening balance sheet as on 1st day of the April and restate the financial statement for the comparative period 22-23. In such a case, the first time adoption adjustment as on 31st day of March 2023, because 1st April 23-24 ல இருந்தானே நம்ம வந்து அடாப்ட் பண்ண ஆரம்பிக்கிறோம், that day should be considered. Instead of 1st April, go back to one day, 31st of March should be considered. So like that you are having FAQs. As per Indian GAAP, that is our normal thing, what we have followed till now, proposed dividend was required to be recognized in the financial statement for the year for which it pertains to, even though these were declared in the what year? Subsequent year. Kandipa. Proposed dividend நம்ம வந்து next financial year தான் declare பண்ணுவோம். Still current year ஓட P&L நம்ம prepare பண்ணும்போது அது include பண்ணி தான் prepare பண்ணுவோம். Section 115 JB of the Act already provides for adjustment for dividend for computation of book profit. As per Ind AS, amount of proposed dividend is required to be recognized in the year in which it has been declared rather than the year for which it pertains to. கண்டிப்பா லாஸ்ட் இயரோட டிவிடெண்ட் ப்ரப்போஸ் பண்ணுறது கரண்ட் இயரில் இருக்கும். அப்போ கரண்ட் இயர் P&L வந்தால் போதும். ஆஸ் பர் Ind AS லாஸ்ட் இயரில் வர வேண்டிய அவசியம் இல்லை. அக்கார்டிங்லி ஆன் டிரான்சிஷன் டு Ind AS, the amount of proposed dividend for financial year 22-23 which was recognized in P&L account for in financial year 23 is required to be reversed and credited to retained earnings. ஸோ Ind AS ஃபாலோ பண்ணுறதுனால லாஸ்ட் இயர் நம்ம என்ன பண்ணி வச்சிருப்போம்னா P&L அக்கௌண்ட்டில் அதை ப்ரொவிஷன் வச்சுருப்போம். அதை வந்து ரீடைன்ட் ஏர்னிங்ஸுக்கு நம்ம என்ன பண்ணணும்னா திருப்பி ரீக்ரெடிட் பண்ணணும். ரீக்ரெடிட் பண்ணி அதை கேன்சல் பண்ணாதான் adjust பண்ண முடியும். For the computation of MAT, whether these balance would form part of transition amount and thus be adjusted over a period of 5 years is the question. Adjustment of proposed dividend shall not form part of transition amount. Transition amountக்கும் proposed dividendக்கும் சம்பந்தம் இல்லை. Alright. Under Ind AS, adjustment on transition date may have a corresponding impact on deferred taxes. Should the deferred tax on such amount be considered for the purpose of transmission amount? Any deferred taxes adjustment recorded in the transition rate shall be ignored for the purpose of computing transition amount. நம்ம அதெல்லாம் வந்து consider பண்ண வேண்டிய அவசியம் இல்லை. As mentioned in question number 1, clause 1 of explanation 1 to 115 JB of the act provide for adjustment of computation of book profit for the amount or amount set aside as provision for diminution in the value of any asset. Convergence date adjustment may include adjustment for provision for bad and doubtful debts, expected credit loss adjustment at the time of transition. Whether these adjustment would form part of transition amount referred in 115 JB subsection 2 of the act, adjustment relating to provision for diminution in the value of any asset other than one mentioned in question number 1 above shall not be considered for the purpose of computation of transition amount. Therefore, adjustment relating to provision for bad and doubtful debts shall not be considered for purpose of computation of transition amount. And the மாதிரி amount எல்லாம் இப்போ provision for bad and doubtful debts எல்லாம் நம்ம வந்து transition amount consider பண்ண வேண்டிய அவசியம் இல்லை. Under 115 JB of the Act, transition amount has been defined as the amount or the aggregate of the amount adjusted in the other equity, excluding capital reserve and security premium. Yes, on the convergent date. Whether changes in share application money on reclassification to other equity would form part of transition amount, share application money pending allotment which is reclassified to P&L date shall not be considered for the purpose of computing transition amount. Unnecessary things will not form part of transition amount. Under Ind AS, investment in preference shares is considered to be liability and corresponding dividend expense is debited to P&L account as interest cost. Should such interest expense on preference shares be deducted for the purpose of MAT computation? For the purpose of MAT, profit or transition amount shall be increased by dividend interest on preference shares, including dividend distribution tax, whether presented as dividend or interest. How do we account for items such as equity component if any of the financial instrument like non-convertible debenture, interest-free loan, etc. included in other equity as per Ind AS for the computation of transition amount under MAT? Items such as equity component of financial instrument like non-convertible debenture, interest-free loan, etc. would be included in the transition amount that should form part of transition amount. Where revaluation or fair value adjustment has been made to items of PPE under Ind AS as per 115 JB, the book profit of the previous year in which the item of PP are retired, disposed or realized shall be increased or decreased as the case may be by revaluation amount relatable to such item of PP. Whether the revaluation amount to be considered for adjustment should be the gross amount of revaluation or the amount after adjustment of depreciation on the revaluation is the question. For example, the old system was deemed concept. We are having 100 rupees. We have claimed 10 rupees depreciation. So the cost has become 90. Again, we have claimed 9 rupees depreciation. The cost has become 81. 81 rupees asset has been sold for 900 rupees. So 900 minus 81 means we will be earning a profit of 819 rupees. Adjustment for MAT, revaluation amount after adjustment of the depreciation, no revaluation 0. So profit on sale will be how much? 819, which is a normal case. Whereas Ind AS considering fair value revaluation adjustment on PPE, you just look at here. WDV is 1000. We have claimed depreciation of 100. What will become the again next year WDV 900. On that we claim 90 depreciation. It become 810. 810 rupees asset has been sold for 900 rupees. So there is a profit of 90 rupees. Now adjustment for MAT, revaluation amount after adjustment of depreciation. This 729. This is how you have to calculate it. Fair value revaluation adjustment and corresponding depreciation. You tell me the book value was 900, you claim depreciation of 90, the book value become 810. Sir, next year if we claim depreciation on 810, you would have provided 81 lakhs. So 729 lakhs is the adjustment for MAT, that is revaluation amount after adjustment of what? Depreciation. Depreciation provide பண்ணிருந்தா 729 lakhs, 729 ஆயிருக்கும். So your profit on sale to be considered for MAT is 729 rupees oda ஐட்டத்தை நீ வித்திருக்கேன்னு சொல்றாங்க. So profit on sale to be considered for MAT is 819. Sir, you sold for how much? Sale value is 900 rupees. The depreciation profit on sale credited to P&L account is only 90 rupees. Correct? But in the books, old system, 81 lakh rupees you have booked. என்ன பண்ணியிருக்கீங்கன்னா பழைய சிஸ்டத்தில் 100 rupees-ஓட அசெட்டை 10 ரூபாய் டெப்ரிசியேஷன் கிளைம் பண்ணி 90 rupees-க்கு எடுத்துகிட்டு வந்து 9 rupees டெப்ரிசியேஷன் கிளைம் பண்ணி 81 rupees-க்கு எடுத்துகிட்டு வந்து 900 rupees-க்கு விற்றீங்கன்னா ஆட்டோமேட்டிக்காக 81 lakhs என்ன ஆகுதுன்னா ப்ராஃபிட் புக் ஆகுது. ஸோ revaluation amount after adjustment of depreciation நீங்க revaluate பண்ணல, so the entire 81 lakhs is booking as what? Profit. But இங்க என்ன பண்ணிருக்கீங்கன்னா considering fair value or revaluation adjustment in PPE, WDV is 1000, sir, depreciation is 100, WDV become 900, depreciation of 90, WDV as is 810. 810 rupees இருக்கிறத நீங்க என்ன பண்ணிருக்கீங்கன்னா 900 rupees-க்கு வித்திருக்கீங்க. இப்போ இங்க பாருங்க, this is WDV or deemed cost. Deemed cost means முன்னாடி வந்து ஒரு அசெட் 100 rupees தான் இருந்திருக்கு, அதை நீங்க வந்து இண்டே சப்ளை பண்ணதுனால 1000 rupees சொல்லி ரெக்கார்ட் பண்ணிட்டீங்க. ஸோ ஃபேர் வேல்யூ ரீவேல்யூவேஷன் அட்ஜஸ்ட்மெண்ட் வந்து 900 rupees எக்ஸ்ட்ரா ரெக்கார்ட் பண்ணிட்டீங்க. தட் மீன்ஸ் அப்வர்ட் ரீவேல்யூவேஷன். அப்படி 900 rupees அப்வர்ட் ரீவேல்யூ பண்ணதுனால நீங்க நார்மலா இருந்திருந்தா 10 ரூபாய் டெப்ரிசியேஷன் வந்திருக்கும், இப்போ 100 ரூபாய் டெப்ரிசியேஷன் வருது, எக்ஸ்ட்ரா 90 rupees டெப்ரிசியேஷன். நார்மலா இருந்தா 90 rupees புக் வேல்யூ வந்திருக்கும், 900 rupees வருது, 800 rupees எக்ஸ்ட்ரா. நார்மலா இருந்திருந்தா 9 rupees டெப்ரிசியேஷன், இப்போ 90 rupees டெப்ரிசியேஷன் எக்ஸ்ட்ரா 819. நார்மலா இருந்திருந்தா புக் வேல்யூ 81 rupees தான் வந்திருக்கும், இப்போ 810 வருது, ஆனா அப்ப எவ்வளவு எக்ஸ்ட்ரா? 729 எக்ஸ்ட்ரா. ஸோ திஸ் 729 should form part of என்ன வேல்யூ? என்ன ப்ராஃபிட்? புக் ப்ராஃபிட். ஸோ 729 இஸ் amount standing to the credit of the revaluation reserve. பிளஸ் உண்மையான ப்ராஃபிட் புக்ல காட்டுறது 90. ஸோ 729 plus 90 போட்டா 819. ஸோ வெதர் யூ have what or what revalued or not, the profit remains the same. So the book profit for the previous year in which the item of PR retired, disposed, realized or otherwise transferred shall be increased or decreased as the case may be by the revaluation amount after adjustment of the depreciation on account of revaluation relatable to such asset. This has been explained by an illustration as under 5. How should adjustment for service concession arrangement be treated for the purpose of computation of book profit? Adjustment on account of service concession arrangement would be included in the transaction amount and also on an ongoing basis. So basically this discussion are purely an Ind AS. That is, if you know the FR subject, this part, it is very easy for you. Otherwise, sir, I can't teach you what is there in the FR transition amount, sir. Then I can, sir, take FR subject. So if you know that part, then this part will be very easy. Otherwise, what I am saying is leave it this part, don't read, because this is only circular, man. Circular will not be tested in examination. If you are able to understand, you read it. Otherwise, don't read it. Without read that only, we have done 3 questions. Only that 3 questions is only important for examination. So we have explained what is the MAT. Now here onwards is a very easy part, man. MAT in special cases, MAT credit under section 115 JAA and computation of total income under normal route. So you revise, sir, start doing the questions from the MAT, because doing the question from the MAT plays a major role. MAT for Ind AS company is little important for this time, because the MAT under normal has been asked last time as the first question, 8 mark or 10 mark question. So do this part, my dear lovable students. We'll meet in the coming session for completing the MAT.